Hi,
Hey,
everyone. Good evening, good morning, good afternoon, wherever you are. And very warm welcome to this third episode of the Global Classroom series that the University of York runs in collaboration with the Jindal Global University, the Center for the Brazilian Center for Planning and Analysis, as well as Mahidol University. We are delighted today to continue the conversations that we've had over the last few weeks on the politics of global development, in which we've looked at the ways in which ideas and practices of development have been transforming and what this means for the issues, the actors, the agents of development. Um, Today, I'm delighted to welcome colleagues from SEBRAP, Zoheb Khan and Pedro Moalem, to talk to us about the green bond markets in the global south. In thinking about the politics of global development, we have generally been concerned with the agency of global south actors, and I think today's lecture will be an interesting and exciting way to think about the role of those actors, state as well as non-state, I think. So I'll hand over to our colleagues from SEBRAP. Over to you, gentlemen.
thank you so much, Indraj. It's a pleasure to be here and have this conversation, to start this conversation. And we thank you and Chris and everyone else involved in organizing this global classroom. It's a huge honor to us to contribute to this initiative. And as you, Indraj said, our class is about the title is Leveraging Private Means for Public Goals, Understanding and Critiquing the Role of States in the Global South in Developing Green Bond Markets. And before we start with this, I want to introduce myself. My name is Pedro Moalem, as Indraj said, and I am a postdoctoral fellow at SEBRAP, and I've been engaged with the study of financial sector from a political and institutional perspective over a few years now. And this presentation is about a project that I'm developing with a colleague, Zoeb Khan, that who will have the opportunity to present himself in a second, which is also from SEBRAP. And today, we will delve into a topic that is usually associated with economics and economists, which is green finance and specifically green bonds. And this topic remains usually unreachable to social scientists and all the other mere mortals, which are not economists, due to its heavy reliance on expert jargons, which makes it sound like a mostly technical issue. But we believe this tendency, if we can say in this way, has served to hinder and block interdisciplinary and critical approach to green finance. And in this sense, we think and envision this class as an open invitation for researchers interested in explore some complex and deep questions behind the thin surface of technocracies that is usually related to green bonds. And these deep and complex questions involve the state roles in addressing pressing matters such as the climate crisis, some recent shift in the political economy of finance, and its underlying change in dynamic of power distribution and among other issues. So to achieve these questions, or to approach these questions, we shift our discussion from focus solely on the financial instruments themselves, to examine the broader social relations that enable them in the first place. So we pose questions such as what the role of the state in shaping and constructing these markets. What are the motivations of policymakers, and how do they interact with other actors, private and international actors? And most importantly, what are the political and economic consequences or implications of this process? So we will today share some findings of ongoing research with you, and Zohaib will now provide a more detailed overview of this class. I will change
Thanks.
our slide.
Thanks, Pedro. So yeah, I'm Zohaib Khan. I'm also a postdoctoral researcher at the Brazilian Center of Analysis and Planning, and also an associate at the Center for Social Development in Africa at the University of Johannesburg. And across my research, what I'm interested in is how different types of coordination between state and non-state actors can hinder or promote public developmental objectives. And so, like as Pedro was saying, don't get too caught up on kind of financial jargon and stuff like that. What's more important for us is the broader issues of how these interactions between different actors promote equity and democratic policymaking. So this is just an outline of what we're going to talk about today. So to begin with, we'll talk through two examples from Brazil and South Africa that show the roles that states are taking in building green finance markets. And these examples illustrate this wider point about how states are responding to developmental challenges like climate change under a somewhat new paradigm, where states are encouraged to leverage the private sector to achieve public goals by introducing policies that provide various incentives for private investment. And a major public goal now all over the world is climate change, right? So it's mitigating climate change itself and adapting to the climate change that's already happening or that is about to happen. So in the next part of the presentation, I'll outline that challenge and the enormous resources that are required to meet it. And because so much money is needed, the consensus or mainstream view now is that we should be incentivizing and making it as easy as possible for private capital to invest in environmentally sustainable or neutral infrastructure. And green bonds are part of that green finance universe. So I'll also talk about exactly what those are. And this mainstream view is quite positive about the potential for green bonds to help us in this climate change challenge, but there is also significant contestation, and Pedro will talk us through those more critical views. And one of the more critical narratives that's useful for our purposes calls the new role for the state in stimulating private investment the de-risking state. After this, we'll go into our case studies. So we look at Brazil and South Africa and the development of green bond markets and the state's roles as de-risking states in these new markets in each country. And by doing so, we are trying to build a framework to kind of explain varieties of de-risking states. So in different contexts, we see different types of de-risking states, right? And we chose to compare Brazil and South Africa because both represent the largest economies and financial systems in their respective regions. Both countries have high levels of inequality, and both countries have major intensifiers of climate change. So in Brazil, it's deforestation. In South Africa, it's very large coal-based power production. And in both countries, there are also, an expectation that a lot of people are going to be affected by climate change and changing weather patterns. So how each state interacts with large, powerful private interests to respond to climate change is really important to try to understand. And then to end, we'll just speculate a bit about what these cases show us about new forms of state action that is exemplified by green bonds and what the consequences of that might be. Over to you, Pedro.
As I have said, we start this presentation by describing two examples that shed light on some of the issues we will be discussing today. So the first example is the Brazilian project Ferrogrão. Ferrogrão is a massive ferrogrão. The word ferrogrão is the combination of iron, ferro, and grão, and is a massive infrastructure project set through a public-private partnership, which comprises 33 kilometers railway link the center of Mato Grosso, as you can see in this image, in the city of Sinop, to the ports of Pará in the extreme north of Brazil. And this is a crucial area for Brazil's production and transportation of commodities, and in particularly the soybeans. And this railway has the potential to transport 52 million tons of commodities per year, and it could offer cost savings compared to the road transportation. And more than that, the estimations shows that this railway could reduce carbon emissions by 77% in this transportation. So there is a very positive view from the public entity responsible for structuring the PPP, the public-private partnership for this project, the Empresa de Planejamento e Logística, Company of Planning and Logistics. This is a public company. And in line with this perspective, and upon its request, a private consultancy firm, the Ernst & Young, in 2021, certified Ferrogrão's green nature, mentioning in this certification the compliance of this project with international sustainability standards outlined by the Climate Bond Initiative. So this is some of the actors that we will return in a second. And this certification enabled the issuances of green bonds by prospective partners, private partners of this project, and attract to this initiative international investment and legitimacy. So initially, the green nature of Ferrogrão seemed to be straightforward and very clear. However, a number of critiques have arisen over the years, questioning its actual sustainability or green nature. The first critique is about the fact of Ferrogrão crossing part of the Amazon forest. And some studies have shown that this fact of crossing the Amazon forest have impacted a number of indigenous land, and that the groups, the affected communities hadn't been been consulted, and this lack of consultation violates the Brazilian and international human rights law. So if this was not enough, there are also concerns about the potential expansion of the agricultural frontier stimulated by the railway, by Ferrogrão, which could lead to an increased land demand, deforestation, water consumption, the pesticide usage. So given all these concerns, a question arise. So Ferrogrão can be indeed considered green or ESG friendly. So more than trying to answer these questions right now, I would like to draw attention to some implications and some issues that we will discuss. So these new debt instruments, such as green bonds that we will explain in a second, add complexity to the definition of what qualifies as green. And state policymaking begins to intersect with a novel international governance framework to finance itself, and also to gain legitimacy through a green rhetoric. And at the same time, local stakeholders may find their demands overlooked due to overly narrow criteria of what is green. So in ultimate instance, we can say that this new dynamic appears to constrain alternatives paths of actions in tackling the climate issue in a number of ways. So we can go to the next example and then return to these questions in a moment. Zoeb.
Yeah, so on the next slide, I'm going to talk about a similar case in South Africa that also illustrates new forms of state action and highlighting the role of this level of international cooperation. So the Just Energy Transition Partnership, or JETP, was signed at COP26 in 2021, and it's $8.5 billion committed by donor countries and associations, so including the EU, US, UK, committed to help South Africa to achieve a just transition in line with its own national planning. And a just energy transition, there's contestation about what that term means exactly, but broadly, it's the idea that when we are building a new energy system and a whole new economy around that to replace fossil fuel-based systems, in addition to being better for the environment, this new kind of economy and sector needs to be at the same time better in terms of social outcomes. So benefits of the new sector and economy should be shared, like profits, ownership, employment, and especially with groups that we think of as traditionally being excluded from economic development. So, I mean, is the JETP something that promotes energy justice? I mean, it's hard to say at this point, but there are some concerning developments. I mean, firstly, the vast majority of the funds that have been committed to South Africa are in the form of loans. So this is going to have to be paid back. The implications for increasing the national debt burden. And a lot of the money has been earmarked specifically for building markets for green finance, where instruments like green bonds are traded. And the point of this technical assistance for market building is that eventually better markets will make South Africa a more appealing destination for foreign investors, and as a destination for less risky profit making. Another feature of the JETP has been very little public participation in which projects are selected, and very limited transparency around where money that's been committed so far is ultimately going to end up. So what this all indicates is that in this model for tackling climate change, where the state promotes green finance, the benefits for investors seem to be quite clear. And if they invest in a lot of green infrastructure, then maybe that's a good thing for the environment. But where ordinary people are in this equation is less clear. And it's a situation, or in this partnership, the state has played a leading role, but the lack of broader public participation has implications for democratic policymaking. Next slide, please. So I'm going to just take a step back and talk about the problem that things like federal grant, the JETP, green bonds, what is it trying to address? The problem is climate change, right? And it's important to emphasize that mitigating and adapting to climate change is going to be expensive. So in South Africa, the World Bank estimates it's going to cost around $400 billion, and that's between now and 2050. And that's more than the entire GDP of the country. And it's broken down into various components, but I won't go into the detail of that. I think it's just sufficient to say that it's going to be expensive. On the next slide. So while I've just talked about figures for South Africa, and in other countries it'll be different, but I think it's unquestionably true that for most developing countries, climate change is going to be something that will require a lot of resources. And how are we going to pay for that? So on the left, we've got figures showing how debt has increased substantially between 2013 and 2023 in the 4 regions where developing countries are concentrated: in Latin America and the Caribbean, Middle East and North Africa, South Asia, and Sub-Saharan Africa. And the red portion of those bars shows the portion of total debt that's public or government debt. And so that what that graph is saying really is that the space for developing countries to borrow money to finance important public objectives is shrinking. And if you're not going to borrow money, then you finance it through your public budgets. And public budgets finance primarily through taxation, right? And taxation, that your tax revenues increase when economic growth is robust and at higher levels. But the graph on the right is showing that again in the same 4 regions, the trend in output growth over the last few years and the forecast for the next few years, the growth rate's expected to be significantly lower than it was in the years before the pandemic. And so that's another constraint on the state's ability to spend. And so given these challenges for states in the global south, a new paradigm for development has emerged. And Pedro, you can change the slide, please. And that paradigm calls for the enlisting of private capital as a partner in the process of development, right? Or as an investor in national development. So financial markets and assets have grown massively over the last 40 years, and many see this as an untapped source of funds that could be deployed to more productive uses, such as climate change, adaptation, mitigation. And for some parts of the investment universe, there is appetite to do this, right? And we see this in movements like ESG investing and impact investing. And what these are, broadly, are approaches to investing that are triple bottom line. And that just means that in addition to maximizing financial return or profit, investors are also concerned about environmental and social risks, or in the case of impact investing, how to promote environmental and social outcomes through investment. And the idea is that states should support these kind of investment movements. And a way to support that is to structure this participation of private capital through the development of financial instruments and the markets that they are traded in. And one of these instruments is the green bond. And on the next slide, I explain what those are. So they are publicly traded debt instruments. And this just means that if I'm a company that needs to raise money, I can go to the stock exchange and advertise that. So for example, I can say, I need $1 million. And for everyone that gives me $1, I'll give you 10 cents back in interest earnings, right? And that's what bonds are, basically. It's the issuer is the entity that requests the credit, and the investor is the entity that lends the money to the issuer and expects to get some profit from that investment in the form of interest. And you get different types of issuers. So governments can issue bonds, and that's, you call that a sovereign bond, or a corporate bond is where a company requests credit. And green bonds are a special type of bond where the issuer makes a commitment that any money that they raise from the issue of that bond will be spent specifically on green projects. But what is green? There's a lot of controversy around this, due to the concern that issuers can try to greenwash. And greenwashing is where you say that you're investing in green projects to attract investment, to build a better corporate image, but you're not really doing that. And so, as Pedro has mentioned, in the case of Ferrogrão, you have these different frameworks of standards that have been mostly developed by international and private organizations that classify different types of projects and say what's green and what isn't. And examples are things like the Green Bond Principles, the Climate Bond Initiative. And issuers will usually reference these guidelines when they release a bond offer in the stock exchange. And the idea, the proponents of green ones believe that with robust kind of functioning green bond markets, you can attract a lot of investment, including from foreign investors, and that can help to fill that big climate change funding gap that I was talking about. And green bonds are still quite a small part of the overall bond market, but it's growing significantly. So got a market now that's 9 times bigger than it was in 2016. But there are barriers for the more kind of rapid, sustained growth of this market, and especially in developing countries where investors might be hesitant to kind of commit to an investment because of things like exchange rate risk. So, not all currencies are as stable as the dollar or the euro, and that can affect the value of your investment, or political instability. So in developing countries where you've got higher burdens of poverty and inequality, that typically leads to greater social instability, and that can be damaging to economic, financial performance. And so the idea of this new paradigm in development is that states should work to reduce these barriers, and there is widespread support for this approach in international organizations, in governments in the global north and the global south. And yeah, Pedro will talk next about some of the kind of theoretical framing of this idea.
Yeah, so far Zoab has provided us with a story that is kind of easy to grasp, because it's kind of a common sense of the public debate on this issue. the story goes as follows. Our problems are huge, and solving them isn't cheap. And the good news is that the private finance actors are willing to help us, and the innovative financial tools like green bonds have already been developed. And these bonds, these financial instruments can finance, can fund projects such as reforestation, renewable energy, clean transportation, so on and so forth. So it's up to the state only to remove the barriers to the flourishing, to the developing of these markets. So this is a happy story. However, there is far less consensus regarding the assessment of real environmental and social impacts of these instruments. So the story gets a little bit more complicated when we look to a broader literature on this issue. So upon reviewing this literature, we find a clear divide between mainstream studies which dominate economic and policymaking circles and discussions, and a small number, but very important number of critical studies from different fields: geography, anthropology, political economy, social legal studies, and so on. So not only they differ drastically in their overall assessments of green bonds, but they also diverge and in their analytical focus, how they identified problems and what kind of problems they identified, and their policy agendas. And regarding the role of state, there are also a different view of what state should and have been doing. On the one hand, mainstream studies, and this is something that I've already mentioned, I will try to go faster here. These mainstream studies view green bonds as a win-win solution to tackling climate crisis. They can be beneficial for nature by enabling green projects, and also for the private sectors, facilitating and creating new opportunities to profitable investments, and also for the government by supporting climate policies or climate actions without significant public expenditure. So the focus of mainstream literature lies on the economic incentives to encourage the private sector's involvement in this agenda. And the problems mapped here revolve around the obstacles, the barriers, as Zoeb was saying, arising the barriers to the market development, and how to ensure the appropriate incentives. So what are the regulatory uncertainty, the lack of transparency, the local risk, and so on. And the policy agenda in this sense is to fix the market failures and create incentives to overcome these problems. So enhancing corporate disclosure regarding both pre and post bond issuance, introduce state incentives for green bonds, and promoting regulatory reforms, and so on. So the picture here is a state as a market failure fixer. The state works just for this end. However, critical studies aim to amplify the understanding of the social and political consequences of this consequences and constitutions of these new instruments. So they perceive the green bonds as deeply problematic, particularly due to the gap between their promises and their concrete effects or consequences. And the focus is here is not on the incentives, but in assessing the effectiveness and the impact of this financial instrument from the perspective of the affected communities and local actors, on determining if the resources of green bonds are allocated, in fact, to projects that wouldn't be funded by conventional or vanilla bonds, and grasping the power dynamics that are attached to these bonds and their governance. So the conclusions are very pessimistic in this case. These studies uncover the widespread greenwashing, as Zoebo was saying as well. And more than that, some studies identified that and the Ferrogrão can be an illustration of this, that green finance can serve to expand the capitalist boundaries or frontiers, in an idea of land grabbing or spatial fix that literature, the critical literature, usually talks. And all this can, instead of protecting nature, can put nature to work in favor of capital accumulation. So, and additionally to that, and our last point that I want to highlight is that a market logic starts to get strained, or a market logic over public policy starts to be increased in this sense, and in this process make already powerful financial actors even stronger. So the policy agenda in this point is not to fix the market, but create alternatives to green finance and specifically green bonds. And the state in this case seems to be emerge as subservient to financial interests. But these studies are more interested, as I said, to assess local dynamics and are not very much concerned with the state's roles, how policies can bring a new kind of politics and questions like that. And to gain insight into these questions of state roles, we turn to Daniela Gabor recent works and analysis about a newly emerging consensus on state intervention in green finance. I will skip this slide. Okay, so Daniela Gabor analyzed recent agendas of World Bank and G20 on development and infrastructure, and suggests that they show us a new consensus regarding state action on climate issues. She says that in contrast to the Washington consensus agenda of privatization and macroeconomic stabilization and capital and trade liberalization and so on, the new global effort has reorganized state intervention in the development realm and in the climate realm around partnership with global finance. And what she is arguing is that state is trying to greening the economy through transformative investability. The idea is to create investable project here to attract at the local level global investor and channel their funds to finance ESG ambitions. So that's basically what Zoheb was explaining to us. And the state, she says, play a very important role in this point. Its ultimate goal is to escort or to guide capital into de-risked asset classes. So the state must build mechanisms to enable and attract investments in certain asset types by mitigating risks or eliminating risks for investors' profits. So instead of just privatizing public companies and just shrink the state, now the state assume a new role to de-risk private assets to investors. So before mentioning what are the mechanisms that the state use to do this, I would like to highlight this is a new logic of statecraft that has been dominating green finance debates. That as I said, it's the first from the neoliberal state, because it involves using what is used to say the developmental tools and instruments, but with the state lacking an autonomous strategic vision. So the state is not trying to promote a specific national development. It is only using the instruments here to construct new markets and new de-risked asset classes. And this can be done through a number of mechanisms, including fiscal incentives, guarantees to the issuances of green bonds, clauses of first loss risk absorption in projects with public and private participation, regulatory reforms, and so on. So trying to go deeper into these mechanisms, Gabor, in a recent work co-authored with Benjamin Brown, elaborate the notions that the climate state, let me see if I am in the right slide here. Yes. That the climate state actions is shaped by macro financial regimes. And this means that in addition to specific incentives, the political institutional structure of a state is crucial to understand its role in developing green finance. So this new model that she proposed with Ben Brown can give us a more broad context of state action. So what is a macro financial regime? Macro financial regime is a combination of institutions that shapes credit and money creation and allocation, so in the given domestic territory, and by doing this, influence the pace and the scope of a green transition. So what are the institutions that shape how credit and money are created and allocated? And they mentioned four pieces or components of green macro financial regime. I will be brief on this, but in their model, there is a macroeconomic policy mix, which is a combination of fiscal discipline and inflation control or management. Also, the industrial policy, all the actions, they take policies and regulations promoting specific sectors, how the state coordinated actors and policies, and how roles and responsibilities are defined. And also, they mentioned the support coalitions. So what are the groups backing and legitimizing state actions? So they suggest that the combination of these different institutions can result in different types of states. And they also argue that the types at the opposite poles, the carbon shock therapy and the big green state, as you can see in this slide, do not exist in real world experiences. And the first one is just to correct, that they state that correct carbon prices signals, and in which the transformation to a green economy occur through market relations in a very disorderly way. And the second one represents a comprehensive planning and disciplining of capitals to preferred resource allocation. So both policies that do not exist in real world experience, and what exists, and it is the dominant paradigm and their current status quo regime, as they say, is the de-risking state. They argue that can be a different degree of state interventions, thinking on both poles inside the de-risking state, but the dominant feature remains the goal of incentivizing and ensuring green investments, and the dependence of the state on financial profits. So the conclusion is very similar to the critical literature. This type of state undermines climate justice, because it make financialization process strong or stronger, transforming nature in a financial asset, widening socioeconomic inequalities, and facilitating in a kind of accumulation by the risk, but at the same time not promoting the ESG goals as it was promised. Okay, so based on this idea, we can understand that what is the broader political economy and the main features of the state actions, but we still don't know how can we bring local political dynamics and socioeconomic diversity and contextual contingencies back into the analysis. And we believe that this is crucial because in our own analysis, certain features or characteristics of our cases remain unaddressed by this idea of the risking state itself. So we are trying to think here in varieties of the risking state. So what is not explained by the idea of one model of the risking state with only different degrees? The variety of domestic political dynamics, the diverse forms of domestic and international interactions, the existence of different and diverse architectures of financial markets, specifically of green bond markets with different shapes in terms of sectors and issuers. And more than that, we also acknowledge that the state action can be very complex and sometimes disorganized and incoherent. And the idea of Gabor that this new consensus is a coordinated campaign for the global diffusion of a new modality of state governance might oversimplify and overlook these complexities of different local contexts. So drawing on her work, we try to develop a comparative framework to provide insight into the varieties of the risking state and a more nuanced descriptions of different forms of state actions and mainly to understand the different forms of green bonds or green bond markets in these countries and their consequences, and also to understand what is next to green bond. We are trying to propose a framework open to political and institutional possibilities for changing the future. Okay, so Zoeb, you can go presenting our cases. I will change the slide.
Okay. So in this next slide, we created this table based on the idea of creating varieties of de-risking states, building on the work of Gabor and Brown, where we're trying to bring in the local and contextual dynamics to help explain that variety in de-risking. And on the left, we've got variables explaining that variety based on what Pedro has just presented. And there's a lot of detail here, so we're not going to go into everything. We'll just highlight bits that are that seem more interesting to us at this point in our research. So starting with South Africa, two major political economy factors are that we've got a very big and strong coal lobby, just based on the history of carbon-intensive production and industrialization in South Africa, and that has a lot of political influence. And we also have monetary dominance. So this means kind of macro regime that's characterized by a commitment over the long term to inflation targeting, criticized as being at the expense of the promotion of employment and productive investment. And that's coupled with high interest rates. And what this has done is it's contributed to financialization in the economy over the last 20 years. And that just means a growing share of the economy that's taken by finance and financial services, while productive sectors like manufacturing have stagnated. And then there's the issue of political coordination. So in South Africa, the really kind of concrete, organized development of green bond policies and frameworks and advocacy to make that happen has come from within the state two of the highest, most important institutions. That's the presidency and the National Treasury. Presidency, or the president of South Africa, is widely perceived to be someone who is pro kind of established business and by extension pro finance, which is very much in contrast to his predecessor before 2018. And you've also got, in terms of the market actors that were dominant in this building a coalition around green bonds, you've got a very strong presence of banks and very coordinated action among them through the banking associations. And I think what these characteristics could have influenced the development of the green bond markets in particular ways, right? So in recent years, the major issuers and beneficiaries of green bonds have been the commercial banks, which have issued green bonds for investments in renewable energy infrastructure. And we don't really have a good view of the results or effectiveness of green bonds. So approximately $3 billion has been successfully issued in the local market, but in terms of aggregate effects on the environment, on social outcomes, we don't really know very much. Some studies accuse green bonds to date of having had untransparent benefits or benefits on a very small scale, and some have been accused of greenwashing. So, for example, one of the big banks in South Africa has been criticized for engaging with green bonds as a sort of marketing exercise, right? So it's signaling to foreign investors and to the South African public that it's committed to the fight against climate change, while at the same time maintaining much bigger investments in fossil fuel industries that sort of cancel out the positive impacts of new green projects that are financed through green bonds. So yes, in South Africa, we've got highly coordinated action at the highest levels, state institutions, and then the market level, very strong coordination among the banks. And so that influences the way that green bonds have developed, with particular instruments of de-risking, relating more to the maintenance of a kind of favorable monetary regime, tax breaks for issuers, and beyond that, we don't know much about specific elements of de-risking in individual projects, and that's what our research is going to try and uncover. And yeah, Pedro will compare that now with the Brazilian experience.
Yeah, as we are short of time, I would highlight that in Brazil, a particular development of the Brazilian case was the election of a far right-wing government led by Jair Bolsonaro, which was driven by an agenda of environmental deregulation and a squeeze in human rights laws and policies. So it was a government that accelerated the destruction of forests and intensified the violence against traditional communities. So the government itself hasn't a centralized agenda for green finance, and particularly for green bonds. So these markets evolved through a collaboration between non-financial private groups and some state bureaucracy and political groups in Brazil. So it was a much more decentralized promotion, mainly as a reaction to the centralized agenda of destruction of Bolsonaro. And the relations with international actors also took place by these decentralized or bureaucracy level partnerships, and also with private sectors, the private sector itself, mainly the non-financial private groups. And these partnerships encouraged a greater private coordination through new governance platforms, which played a very important role. So to give you a sense of these markets, now it surpasses 15 billion of dollars and 170 issuances in 2022. This is the last number we have, and this is the largest market in Latin America, which experienced substantial growth since 2019, that when Bolsonaro came to the power. So what is intriguing in this is that despite Brazil's financial sector being dominated by big banks, just like South Africa, in Brazil, non-financial corporations have taken the lead in issuing green bonds. And we think that, and we'll talk about this, this is linked with the way the green bond market is organized institutionally by the state. So at the next slide, we try to offer very briefly some explanatory factors or claims for this. Zoe, please.
Yeah, so in South Africa, we can hypothesize that we have a center-right government, which I put in quotation marks because it's kind of difficult to classify a government that's consistently socially progressive while being economically conservative. And it's, the country's led by a president who's seen as pro-business, as I've said. His party is not faced electoral challenge since the 90s, which might change this year, and that's very different to what we see in Brazil. And also, unlike Brazil, you've got a South African government, over the period that green bonds are developing, that has enjoyed kind of broad global respect, not just in fiscal and monetary management, but also in terms of its attempts to meet its commitments under the Paris Agreement, while also this recognition internationally that commitments in some parts of the state, like in presidency and national treasury, are made difficult to act on by the strength of the domestic coal lobby. So one hypothesis here we have is that support for green bonds in the most important state institutions could be a way to bypass that strong coal lobby in the domestic policy-making process and accelerate the green transition. Because the governance and decision-making around green bonds is between market participants, right? Local foreign market actors. It's not subject to democratic control. And we can also, another hypothesis could be that very consolidated and coordinated action between the banks could be because they see an opportunity to improve their ESG credentials abroad and access more green credit. This is, because our economy is very carbon intensive, that can be a problem for some environmentally conscious investors. And then finally, as the market grows, we see this kind of concentration of opportunity among dominant players. And this could be a result of very strongly coordinated initiatives between, we call them elites in state and market institutions. And that's possibly indicative of crony capitalism, which many scholars think is a pervasive feature of the South African economy. It's hard to say at this point if that's what's happening, but it is worth raising the question. So Pedro will go through Brazil.
Yeah, and what I want to highlight that in Brazil, the fact that we had a far right-wing government in power was key to the way the institutions coordinated or not coordinating themselves, because what we have found to the moment is that the state support for green bond issuance in Brazil emerged as a decentralized response to the government lack or destructive environmental agenda. So all the public structures such as the Brazilian Development Bank and some public companies and other state actors in a bureaucracy-driven project or initiative started to get contact with international actors, and the way the political power was organized influenced the way the market act or state actors get involved in this development, and the state actors in turn shaped the policy instruments that were used and the pattern of public and private, domestic and international relations in developing these markets. What I think is important to highlight here is that this process lead to a new market structure or spurred changes in the Brazilian financial sector. So the specific form that the de-risking state assumed in Brazil create opportunity to challengers in the financial sectors and facilitate and expanded market-based finance and credit expansion. So just in order to compare, by 2023, corporate debt based on the capital market had risen from 25% in 2016 to 43%. So it's almost doubled in this period. So another conclusion that I want to highlight here is that market-led initiative managed to mitigate the government negative image in some sectors, and this had a good side of the story, which is to promote at least some green actions during Bolsonaro government, but at the same time, this could legitimize the Bolsonaro administration to some extent, despite all the environmental concerns. And we want just to finish with some points to discussion.
Yeah, so this is just summing up. So what we found, there is a consensus among important global actors that we should be involving private finance more in tackling the climate crisis. But there are radically different assessments of whether this is a good idea or not. And states have had very important roles in protecting green finance. And this isn't just in our two cases. You can say very much the same thing in the US or in EU countries. And so a new type of state has emerged that takes on this role, and that's this de-risking state, right? And what we've tried to do is to enhance our understanding of this new role, this de-risking, and the consequences of that, and then try to think about what that implies for the future of state actions to tackle climate change. I think just some lessons to learn from our cases are, the varieties of political dynamics matter. We've got very different political situations in both countries during the time that's of our study that's relevant. So that, up until about 2022, different political contexts where you've got quite different sorts of state and market actors that are taking leading roles in the development of these new green bond markets. Secondly, that de-risking may not be straightforward, right? So we don't always know exactly the form that de-risking takes in particular instances, beyond the broader market building things like technical and political support, tax breaks, macro policies. In concrete individual situations where specific bonds are being issued, a lot of information is not really known, and that's part of our research agenda, to try and learn more about that. And then once we get that information, I mean, can we classify that as something new that's de-risking, or is it just kind of a traditional pro-business, pro-finance kind of policies that we're used to and that long predate green finance? And then different types of interactions produce different consequences in terms of distribution of power. So South Africa, you've got a concentration in the financial sector of who seems to be benefiting more from green bonds, whereas in Brazil, it seems more dispersed and more space is opened for challenges in these markets. And then, yeah, Pedro will talk just through those last 2 points.
Yeah, we think that regarding the potential of these developments for future state actions, one thing that I want to highlight is in Brazilian case, we have seen in the last year new developments of green bonds. So the Lula government has been supporting the expansion of green bonds in the same in a strikingly different way from Bolsonaro, because the government now wants to use a public fund, the climate fund, that is managed by BNDES to fund or finance projects selected through an extensive and great political dialogue with civil society. So this is this kind of a fund could be used to fund green projects, but this fund would be